Welcome back. Three leading regional banks in the U.S. reported earnings today. Those earnings came in line or slightly above estimates. He gives them a buy rating as he expects stock buybacks to continue, among other things. Joining us now is Kevin Heel. He's fixed income strategist and senior analyst at Argus Research, and he joins us now to talk about the U.S. regionals. Kevin, what's your view of this sector? The market has been cautious, to say the least, on U.S. regional banks ever since the blow-up of Silicon Valley Bank quite some time ago now. What is your view of this segment of the U.S. financials?
Yeah, we have remained positive even post Silicon Valley's demise, and we have had these three particular stocks, Regions Financial, Huntington Bank, and Citizens Financial, all on our buy list. The stocks have performed well despite concerns over the overall regional bank exposure to the commercial real estate sector. Loans at predominantly all three of these banks are on the commercial real estate side are well below 2% of their overall loan portfolio, and we expect them to continue to work out those troubled loans, but continue to grow earnings in other sectors.
That proportion of the loan book that you briefly spoke about, that is their commercial real estate loans as a proportion of their overall lending portfolios, correct?
Yes, that is correct. And that's the total, not necessarily the troubled loans.
Would you agree that there's more risk in this sector than there is at the larger money street banks?
Yeah, but in particular that, these three banks are in, strategic growth areas for them, Citizens predominantly on the East Coast. We have Huntington in the Midwest area and Regions in the Southeast area. So we believe that each has their niche there, and they've been able to grow, especially in the wealth management areas and the middle market banking sector, which we believe after the new administration comes in and there's a focus on infrastructure, they will be well positioned to help take advantage of that.
We hear a lot about the incoming Trump administration and relaxed regulations in the financial sector. And again, most people tend to immediately apply that to the giants of Wall Street, the likes of Goldman Sachs, JP Morgan Chase, and so on. Are there positives for the regionals as well in this thesis of relaxed financial regulations in the U.S.?
Yeah, capital requirements are high. They have a lot of, these three in particular and other of the larger regionals have a lot of excess capital. We don't cover a number of the smaller regionals, but we expect with the relaxed regulation that M&A will come back to the front as a lot of banks, smaller banks are facing technology costs and need to merge with others, or there might be some relaxation where larger banks would be able to take over some of these smaller and expand their geographic footprint.
And you're not concerned about relaxed regulation in a sector where it's not uncommon for regional banks to completely blow up, as did Silicon Valley Bank? Yes.
These management teams that at all three of these banks have been around for quite a while. They have hedging programs in place for their interest rate exposure, unlike Silicon Valley did. They're not, running cowboy. It's been, steady growth, selective growth, and sticking to their expertise in particular areas. But with these regional banks are not necessarily, hitting a home run from the equity side. They pay an attractive dividend of these three between 3.5% to low 4%. So that would help provide a buffer in turn. But they've managed their securities portfolio where Silicon Valley didn't, and have taken prudent steps in selling some of the lower coupon securities, taking the loss, and then replacing them with higher yielding securities.
How do you value these stocks? What kind of valuation metrics do you use to assess the valuation that the market is giving these stocks? Is it a price to book ratio? Is it a price earnings multiple or other
price earnings
metrics?
multiple? Yeah, sorry, price earnings multiple somewhere around 13, 14 times. Given we have a solid positive now yield curve after having been inverted for a number of years. This should help lower deposit costs, and you saw that in the fourth quarter, and also increase yields on loans. We expect muted loan growth going into 2025, but expect that with the potential for the new administration to loosen regulations for loan growth to become more attractive, and with potential infrastructure and replacement in those particular geographic areas.
Kevin, thank you for this conversation. That's Kevin Heel, fixed income strategist and senior analyst at Argus Research.